Probably don't think that a war halfway around the world has anything to do with your mortgage in Canada, but it does. And most people won't notice the impact until it already has hit their bank account, when that monthly payment creeps up or the rate they were waiting for doesn't drop. That's when things get real. All right, let's walk through what's actually happening and what you can do about it. 3 things I'm going to break down. First, the pattern, what history shows us and how global conflict affects your mortgage rate. Second, what's going on right now in the Middle East and how close we are to that pattern repeating itself. And third, what you can do to stay protected, whether you're buying, renewing, or just trying to understand how all this ties together. Let's start with the pattern, because once you understand that, everything else starts to make sense. Anytime there's a major conflict, especially in the Middle East, oil prices tend to spike. And when oil goes up, inflation usually follows. That's when the Bank of Canada steps in. They either raise interest rates or hold them higher for longer to slow down the economy. And that move trickles down into your mortgage rate. That's how the chain works. War equals a rise in oil prices, which equals a rise in inflation, a rise in interest rates. Let's look at a few real-life examples. Back in 1973, there was a major war in the Middle East. As part of it, a bunch of oil-producing countries stopped selling oil to the West. Prices tripled almost overnight. Inflation in Canada shot up to 13%, and the Bank of Canada had to respond. They hiked interest rates, and with that, rates took off. It wasn't pretty. Fast forward to 1990, Iraq invaded Kuwait. Oil goes from $15 a barrel to $40 a barrel. Once again, inflation follows. And the Bank of Canada pushes rates as high as 16% to slow things down. Same sequence, but a different year. Now in 2023, we had the Iraq War again. But this time inflation didn't spike as much, so the Bank of Canada eased off. They raised rates a little, but then brought them back down. And why? Because core inflation, the kind that sticks around, didn't really move. In 2011, we had the Arab Spring. Protests, unrest, oil supply issues. This brought crude oil past $120 a barrel. Inflation popped up, but again, the bank held steady. Why? Because the oil price surge was short-lived. Most recently, in 2023, the Israel-Hamas conflict sends oils from $85 to $92 a barrel. It gets some attention. Markets react a little, but the Bank of Canada doesn't move. They hold rates at 5% and wait. So with this, you can see a pattern. If oil spikes hard and stays high, that's when things get serious. But if it's just a quick jump and the prices settle, the bank usually stays out. Now let's zoom in right now. Tensions between Israel and Iran are rising. And when that happens, all eyes zoom in to the Strait or the Hamas, a narrow waterway where about 20% of the world's oil flows through. If that gets blocked or even threatened, oil prices can spike quickly. At the moment, oil is sitting around $74 a barrel. That's pretty normal. But if things heat up, we could easily see oil go back up to $100 a barrel. And when oil jumps that much, it doesn't just affect gas prices, it touches almost everything. Shipping gets more expensive, groceries go up, heating your home costs more, and when all that gets more expensive, that's when inflation rises. And that's where the Bank of Canada comes in. Their number one job is to keep inflation in check. If they see it creeping back up, they hit pause on any rate cuts. In fact, they might even rise rates again, just to cool things off. Now, here's where it starts to hit your mortgage. Most people think their mortgage rate is directly tied to the Bank of Canada does, but that's only part of the story. Fixed rate mortgages are actually based on something called the Government of Canada 5-year bond yield. Think of it like a long-term cost of borrowing money. And when investors expect more inflation, those bond yields go up. And when yields go up, so do interest rates. Back in April, the 5-year bond yield was about 2.46%. Now it's sitting around 2.8%. That might not sound like a big move, but that shift can add 10 to 15 basis points to your mortgage rate. Over 5 years, that's a noticeable change in your monthly payment. So let's connect all the dots here. If the Middle East conflict escalates, oil prices spike, inflation picks up, and investors expect it to stick around, bond yields will rise, mortgage rates go up, and the Bank of Canada delays any cuts that they were planning. That's a chain reaction, and it's already in motion. So what can you do about it? Let's break it down by situation. If you already have a fixed rate mortgage and it's under 4%, you're golden. You're ahead of the curve. Sit tight, Even if rates come down a bit next year, you're already in a better spot than most people. If your renewal is up in the next 6 to 12 months, now is the time to act. Talk to your broker. Get a rate hold in place. It doesn't cost you anything, and it gives you the protection in case rates rise again. If you're buying a home, same thing. Lock in a rate hold while you shop. That gives you breathing room. If rates go up, you're covered, and if they go down, you can still adjust. If you're on a variable rate, keep an eye on your lender's prime rate. Even if the Bank of Canada holds steady, lenders can still adjust rates based on the market trends and bond movement. And if you're watching all of this trying to time the market, here's my advice. Don't overthink headlines. Focus on real signals. That's oil, bond yields, and Bank of Canada policy. Those three things will tell you more than any viral clip or dynamic headline ever will. Oil is like a fuel line for the entire economy. When it gets squeezed, everything downstream feels it. Bond yields, that's investors' anxiety. If they're nervous about inflation, yields rise, and that hits your mortgage before the Bank of Canada even moves. And central banks, they're the thermostat. If things heat up, they tighten. If things cool, they loosen. Right now, they're watching every dial closely. So here's the bottom line. What happens overseas can show up in your next mortgage renewal notice. It might not be obvious, it might not be tomorrow, but the ripple effect is real. Now that you know how the chain works, you're not guessing, you're prepared. If this helped bring you clarity, please hit the like button, follow for more videos like this, and send it to someone who is stressing out about their mortgage renewal. No hype here, just clear info so that you can move with confidence instead of panic. I'm Justin Chaussee. I'll keep breaking this stuff down for you so that you don't get blindsided, and I'll see you in the next video.